Welcome to everyone to our latest Follow the Fed call. Welcome to anybody who's new to these. We will just take 10 minutes of your time to give you an update on the Fed's decision yesterday and what it means for you as treasurers. I'm Nigel Owen, Head of Corporate Origination at Treasury Spring and regular host of these calls. And joining me today is our Head of Trading and Execution, Glenn Stone. Good afternoon, Glenn.
Hi, good afternoon, everyone. Pleased to be back.
Good to have you. And as ever, if anybody's got any questions, please do email us on events@treasuryspring.com. That's events with an S. And we'll address them as soon as we can and come back to you with our answers. But given we promised to only keep you 10 minutes today, we'll get going into the meat of this discussion. And few people probably were surprised by the fact that the Fed left rates unchanged. It had been signaled by Fed members for some time, with the backward-looking data supporting that, and the geopolitical outlook probably too uncertain to make many decisions on just yet. But Glenn, I'm going to bring you in here and let's start with the data. Given the way these meetings fall, we've had 2 months worth of inflation data since last time. First, we saw it flattening out at 2.4% in February, albeit still above the 2% target. But then with the effect of the war on the oil price, we've seen it jump to 3.4%. However, the core PCE Index, the Fed's preferred measure, which actually strips out energy and food prices, that actually eased slightly to 3%, still 50% above the Fed's target. Glenn, how should we be looking at those numbers in your opinion?
Well, core PCE running at 3% is higher than where the Fed wants it to be, period. Expectation is for it only to cool slightly to 2.7% by the end of the year, so still very much higher than is desired. In fact, we really don't see the PCE inflation gauge get back down to 2%, by the end of 2028. But certainly the Fed will not be looking at this, in isolation. It will be looking at it in the context of GDP expectation. And they still, predict a solid growth rate for 2026 of 2.4%, which is quite considerably higher than that of 2025.
Okay, so that's sort of the mix on that side of it. But on the other side of the Fed's mandate, we saw unemployment ease slightly against forecasts for it to remain at 4.4%. Positive news there. But we did see hourly earnings growth dropped to 3.5% year on year, its slowest rate since May 2021. How do you think the Fed have interpreted that?
Well, again, we do see strong employment data coming out of the US. For March, non-farm payroll data showed an increase of around about 178,000 jobs, which was way above Wall Street expectations. These numbers can be revised, historically or backwards, but the labour market looks, overall particularly strong. Although, if one was to look through some of the data, we do see that many of these workers, particularly in the health sector, are added, due to returning strikers. So, perhaps not new jobs created. But the other thing as well that we do continue to see on a downward trend is federal government, which continues to shed roles. But overall, we still have, some wage inflation in there, as you mentioned, at 3.5%, plus relatively low, below expectation unemployment. The jobs market does continue to look strong.
Okay, so fairly clear data looking backwards, but of course, the war in Iran has caused the outlook to be somewhat opaque, with no clear idea on when or how the war in Iran might end. And I'm not going to ask you to predict when that might be, but perhaps it might be useful for our clients on the line if you can talk us through how you've seen short-term rates move over the course of the first 2 months of the conflict and where we sit right now in terms of rates and the market's expectations from here.
Well, we have been on something of a roller coaster ride on shorter term rates over the last couple of months, and they have moved around, not, I wouldn't say wildly, but fairly consistently, depending on what has been, in the media. Ultra short end, sub 3 months, has largely been very stable, but we have seen significant movement in the sort of 3 to 18 month space, where we've swung quite wildly, quite dramatically maybe between expectations of cuts to hikes and back again. But what is quite interesting that quite recently the picture has settled down somewhat. And up until the meeting yesterday, we had seen, some expectation that by the middle of next year, the Fed would be in a position to look at cutting rates, which has matched some of the rhetoric. And the market had been pricing a 25% probability of a cut some point, in the middle of next year. However, since the meeting, and what we have seen as the speech afterwards, we have seen the market perhaps match the Fed's dissent position. That now we have seen the probability of a hike by the middle of next year. And we've seen now slightly over 25% probability that there may now be a hike in the middle of 2027. So definitely something that we need to keep an eye on and continue to track.
And interestingly, against that, while the hold was no surprise, nor the fact perhaps that Stephen Mirren was the one dissenter, again voting for a cut, but some were surprised that the Fed maintained its easing bias, given everything that's going on, and suggesting that it still sees the next move as a cut rather than a hike. Although we did get the three regional Fed bank presidents, Hammock, Kashkari, and Logan, all objecting to the easing bias. Where do you see that leaves us? Is it likely to be a different path to the market expectations we just discussed, or is that where you think the market move has come from?
The market can be looking at many factors at once, but it does look like this descent bias, of the three Fed members, has been matched somewhat in shifts overnight. We've seen a 13 basis point swing, out towards the middle of next year, where we've moved from, probability of a cut into probability of a hike. It is definitely something that is fluid. They are not moves that are as dramatic as what we've seen, at the earlier stage of the war and in the shorter dates, but certainly, the picture is moving and dynamic and needs to be observed as we move forward.
Sure. And I think we all obviously hope that the conflict in the Middle East can be resolved soon, Straits of Hormuz reopened imminently. But even if that were all to happen, let's say this weekend, in your opinion, will we go back to where we were in February with oil back below $70 a barrel and rate cuts priced in for this year? Or have too many things changed now and risk levels will remain higher and what that might mean?
I think that would be a very optimistic assessment right now. Brent climbed through $125 a barrel overnight, and although has pared some of that this morning, it's still highly elevated. With both a production and supply shock in the system, it's going to take some time for that to settle back to pre-war levels, even if the Strait was to reopen tomorrow. Whilst we have a fragile ceasefire right now, getting to any form of conflict resolution may well see continued politicking and threats to escalate to de-escalate coming from both sides, which will likely have fairly significant impacts to the price of oil going forward.
Sure. So lots of uncertainty to consider there. One other area of relative uncertainty that seems to have been removed is who'll be chair for the time of the next meeting. I think we can now be pretty confident that Kevin Walsh will be in place in mid-May. But we still don't know if Jay Powell will remain on the board for the remaining 2 years that he could do, which interestingly would push Stephen Mirren out and deny President Trump a majority of Fed governors that have been appointed by him. Firstly, do you think much will change when Walsh comes in? And secondly, how much does it matter whether Powell stays on or not, in your opinion?
I think it's an interesting question and something I happen to be pondering. What my sort of question to myself was is who casts the longest shadow over the Fed right now? Is it inflation persistence? Is it President Trump's view of where rate path should be, or is it Powell staying in a governing position, albeit not the chair? Although we have seen, from Powell's perspective, the threats of DOJ action call, which has interestingly cleared the way for Walsh's nomination, given the blocking position which was held by Tom Tillis. Powell does appear to be having his "I'm not leaving Wolf of Wall Street" moment, for now at least.
Interesting. Yeah, that's certainly the one to watch as we approach next month's meeting, where of course we will be back with a live call with dot plots et al. Next month. But that does wrap things up for today largely. Obviously, you can keep in touch with us in the interim period. If you've got any questions, a reminder, please email us at events@treasuryspring.com. We'll come back to you on those. You can, in the interim, follow us with our Follow the Fed monthly take on what's happening in markets. The most recent one was out last week, so you can find that on LinkedIn and other channels. And we have started to publish our TS Pulses, which are a hot take on market moving news and events. For any clients who aren't receiving those but would like to, please get in touch with your TS contact. But as I said, we kept it to 10 minutes today. Glenn, thank you very much for your input into that.
Thank you for having me.
And thank you to everybody for joining us. Please enjoy the rest of your day. Enjoy your holiday for those of us who have a day off this weekend, and we'll be back again next month.